welcome to Personal Finance. I'm Gugulethu Cele. We're still coming to you from the Discovery Financial Planning Summit for 2015 from the Sandton Convention Centre. We're going to analyse having the appropriate cover for different life stages now and ensuring that you mitigate against all the relative risks and make sure that you have the right plan to suit you and your needs given the positioning that you are at in your life. To help me unpack this topic further, I'm joined by Kgomotso Masangoa. She's a financial advisor with Discovery, and Andrew De Silva joins us again. He's from Direct Finance Solutions based in the UK. Good to have you both with us to take part in this conversation. I'd like us to unpack the different types of cover, and maybe Kgomotso, you can give us more perspective from the South African market, especially when it comes to the different stages that one goes through in their lives.
Thank you very much, Gugu, for that. The different covers that we have at the moment, when we're looking at risk covers, that's for the death, disability, severe illness benefits. And also then we look on the saving side, the investments, be it education plans, or when an individual actually then creates wealth for themselves. Now, looking at the different life stages, if I recall when I was young, not knowing much in terms of finances, you need to know things about the budgeting. Financial education, which is extremely critical, which people, I believe, need to know, especially when starting off from being a student into starting your first job, all right? There you have, firstly, know how to work on your finances. Don't just, let's say, get your first paycheck, already you're getting yourself into debt like credit cards, getting yourself housing, clothing accounts, and all of that. So we look at things like disability benefits, extremely important, because you start off by having a vehicle which is comprehensively insured. That's whether or not it's financed, all right? But then individuals don't necessarily want to look at covering themselves. As we all know, at the same time that insurance can also be a grudge purchase. So when you're starting off young, you're looking at the disability benefit and also life policy because you're young and healthy, all right? Then as you grow older, going into the 30s, starting to have a family, a spouse, and children, then we look into family protection. That's looking at the life policy, disability, severe illness, education plans for the children, because education can be extremely expensive. And also retirement planning. You're never too young to start saving towards retirement. There's also some nice benefits in terms of the tax deductibilities with certain limits, of course. Then growing older into building yourself wealth and working on your retirement planning. We're looking at estate planning as well. Should something happen to yourself? What happens to those that you leave behind, those who are financially dependent on you, all right? And looking at the retirement stage, an individual go on retirement. Hopefully they've saved up enough to be able to travel the world if they wish to, or retire comfortably, all right? And continue creating wealth and building wealth for themselves if they do have those monies as well put aside.
I want us to review the terms and conditions because I think so often that's where we need individuals like yourselves as advisors to come in and explain those further to clients. Do we often find that clients choose minimal cover for various types of cover in order to make sure that they pay as little as possible?
Yeah, one of the daftest questions you get, but it's an understandable question, is how much will it cost and what is the minimum I need to pay?
Yeah.
And the answer I always give back, and I'm sure you do, is you say, what's the minimum you want to be covered for then?
Do you always get a straight answer though, Kgomotso? You never, because everybody wants maximum cover.
Correct.
But at a minimal fee.
Correct.
Yes, that's true. And sadly, when coming through the consumers, they believe, for instance, if a person buys a house for R1 million, they believe I just need to get a policy of R1 million, either remaining constant or actually tapering down, because they believe the more I pay towards the bank loan, then it reduces. So, Kgomotso, I don't understand what you mean by I need to have more cover that actually increases on an annual basis. We need to take a lot of factors into account. The individual may be starting off single, living in this house of R1 million, but as they grow older, they might then also have a child. Now, if something happens to them, it's not only about the house that needs to be paid off, but there's also a dependent to look out for, all right? So that actually needs more money. So that's an income protection for this young one up until they get to a certain stage. So it's those things to take into account. So it's usually a challenge when you're trying to not sell the minimum policy, premium type of policy, because it's hardly enough. But certainly at the same time, we'll need to look at the realities of the individuals in terms of their income, their money that is exposed, they've got to be able to pay for their premiums, all right? But also working into their budgeting, you realize where the good monies can be used to buy the policies are kind of wasted, if I can say that, with a weekend clubbing or maybe buying junk food. So it's a matter of prioritizing. It's extremely important to sit with the client, talk about budgeting, talk about the importance of having that 6 million rand worth of cover, even though their house debt is only, let's say, 1 million rand, because there's a lot of other factors that have to be taken into account.
I want us to look at the worst case scenario, and maybe within the 30s and 40s, where you've got a lot more responsibilities on your hands. As you've both alluded to, children, you have a spouse. In some cases in South Africa, we have the sandwich generation, where you're responsible for your own children as well as your parents. Are there certain types of cover that can go to the wayside and then you have to prioritize others? But I take it, obviously, as a financial advisor, that's not what you want to be telling your client, especially if they're under, affordability pressures.
If affordability is a real issue, you'll basically prioritise their most priority. I mean, there's a balancing act whether you'd sell someone critical illness and ignore income protection, or sell them income protection and ignore critical illness. Mm-hmm. Unfortunately, there's no right or wrong answer. It's literally, well, which one can you afford out the two? Mm-hmm. With children and a loan, certainly on a mortgage, you're almost crackers not to have at least life assurance, at least. It's like we all want to drive around in a Ferrari or Aston Martin, but we can't all afford one, so you then go down the pecking order of the sort of car you can have. It's the same in insurance. In an ideal world, you'll have a massive life assurance policy, a massive critical illness policy, a full income protection policy, a great funded pension,
oh my goodness,
and a great funded death tax policy. But if you can't afford it, you then have to prioritise. And then it's a personal opinion with your own clients, isn't it? It's their ultimate decision. Well, we'll forget that, we'll have that one.
I mean, if I can answer this using one of my clients' experience, he's widowed and he's got 3 children. Did a financial plan for him. He was in his late 30s, going to early 40s, and he's got quite a huge shortfalls in terms of retirement planning, savings. He works for himself, and also in terms of protection, risk protection. The life policy didn't actually have much, if I can say that. And it was a matter of you need both retirement savings and the life policy, but he could only afford a certain amount of cover. And he said, you know what, let's start with the retirement and then we'll do the life cover at a later stage. And I said, well, no, actually let's do it the other way around. Because if something happens to you today, you need your children protected. How are they going to survive for the next coming years? And for him, it didn't make sense because it's like, no, but I'm alive and I will enjoy the money when I get to retirement. I said, but what if you don't get to retirement and now your children will be left destitute? So at times we actually have to be tough with our clients. I had to kind of not really fight with him, but I had to reason and explain and show him that, you know what, your retirement savings, you'll have to for now park it because most, according to what we have tended needs, you need to have your life cover now, immediately for your children's protection in terms of income. And as time goes on, we'll start working on your retirement. So that's where the professionalism and the experience that you need to bring forth and sit with the client and explain and up until it makes sense to them. So as much as at times we'll set up an appointment with a client to see them for an hour, 3 hours later,
sure,
you're still sitting with the client and eventually getting it to them. And by the time you get back home or to the office, you've got that satisfaction that, you know what, I did something right. It's not all the clients that will eventually see your way, but some you kind of explain and show them the light, So we have to always use our expertise and experience to guide the client, as they may not really know the right thing at that moment.
That's a great answer, because the explanation there is the client actually didn't realise what the real problem was. In his head, he was obviously thinking of his retirement, but the real problem was, well, if you die tomorrow, you've got one massive, your family's got one massive problem.
It's a respectable job that the both of you do, even though it is difficult at times. You both mentioned two very important points earlier on, mitigating against the risks as well as review. And I want us maybe to fast track to someone who has already reached that time of retirement. Are the risks maybe slightly more reduced for them? And do they need to review, enjoying their retirement savings instead of excessive life cover or depending on their
definitely.
needs?
Once you're, say, you'd like to think this would happen, let's say you're now 65, 70, you'd like to think your children are all self-sufficient.
Yeah.
You don't need to work yourself now, so you haven't got an income. So you don't need to protect an income, but you now have a pension paying out. And that's what you ultimately, through life, you've been able to build up to provide yourself with that pension. The only time life insurance, as I said earlier, realises its head then is for the paying of the tax bill, which is a rule in the United Kingdom, to cover the inheritance tax bill. But yes, the ability, or sorry, the need for life insurance and protection diminishes heavily the older you get.
I take it you agree, Kgomotso, on that point?
Yes, sure, I do agree. Look at when you look at the executives' fees, when you look at the estate planning, should something happen to the retiree, if they're going to transfer their assets to their spouse or to their children, whomever they may be, that's where the tax that we're talking about. But also if there's opportunities in terms of creating more wealth, yes, there may not necessarily be that huge need of life policy. And hopefully, for males at age 70, they can still produce, eh? So hopefully it doesn't have a 2-year-old that he'll still need to take care of, because it happens, eh? Life happens.
Life happens.
And then that's when you need to shoot up that life cover over again.
I want your client bank.
So proper planning clearly is what needs to take place. Just before we wrap up the interview, 3 key points for a lot of the clients and even those who are watching as various stakeholders this evening that they need to consider when it comes to the right life plan for various stages in your life. 3 key points, Andrew, to start off with you.
To me, it's all down to priorities. What is your main priority? With your affordability, say, what is your main priority? Is it the life cover? Are you looking to be able to do all of them? But what is the main priority?
Kgomotso?
Important need versus luxury. Don't go and open a Truworths account because now I want to wear the label versus actually having the basic clothes so that the extra monies you're able to use it to buy that life policy for security for your family. Extremely important. And also budgeting, prioritize. Yes, it's great to also have drinks and parties every now and then, but really look at the bottom picture of something happening to you, your children, whomever that you're leaving behind, will they be taken care of?
The B word and the P word, hey? Prioritize and budget. Thank you so much for joining us today and even giving us insights on 72-year-old men about the importance quite clearly exactly of planning and ensuring that you have the right cover for various life stages. A big thank you to both my guests, Kgomotso Masangoa, who is a financial advisor with Discovery, as well as Andrew De Silva, who is with the Direct Finance Solutions based in the UK. That's where we leave it for personal finance today. Do join us again when we explore new terms and theories when it comes to managing your money.